आपको मुंबई, जहां पर आरबीआई गवर्नर मॉनिटरिंग कमेटी में हुए फैसलों की जानकारी दे रहे हैं।
Monitor any signs of generalization of food price pressures which can fritter away the gains in easing of core inflation. Monetary policy must continue to be actively disinflationary to align inflation to the target of 4% on a durable basis. The MPC will remain resolute in this commitment. The MPC also decided to remain focused on withdrawal of accommodation to ensure fuller transmission and anchoring of inflation expectations. I now propose to provide an assessment of growth and inflation. Let me take up first global growth. Global growth is expected to remain steady in 2024 with heterogeneity across regions. Though global trade momentum remains weak, it is exhibiting signs of recovery and is likely to grow faster in 2024. I would like to mention that, I am making several statements, and the supporting data for all the statements that I am making, all the sentences that I am reading out, the supporting data is provided in the footnotes. So therefore, those of you who are interested can refer to the footnotes for the backup data in support of whatever statements I am making here. So let me just restart so that there is continuity. Global growth is expected to remain steady in 2024 with heterogeneity across regions. Though global trade momentum remains weak, it is exhibiting signs of recovery and is likely to grow faster in 2024. Inflation has softened considerably and is expected to moderate further in 2024. Financial markets are volatile as market participants adjust their expectations on the timing and pace of rate cuts by major central banks, who in any case remain cautious against premature easing in their fight against inflation. Amidst the current headwinds, elevated level of public debt is raising serious concerns on macroeconomic stability in many countries. Now, this is a new point which I am just introducing, which I am talking about in this MPC, because this aspect, I think, is an important aspect and it will impact the future trajectory of global financial stability and global financial system. So therefore, this point I thought I must mention here as a part of the monetary policy statement. Now, amidst the current headwinds, elevated levels of public debt is raising serious concerns on macroeconomic stability in many countries, including some of the advanced economies. Global public debt to GDP ratio is projected to reach 100% by the end of this decade. The public debt levels in advanced economies, in fact, are much higher than those in the emerging market economies. The challenges of debt sustainability in an environment of high interest rates and low growth at the global level can become new sources of stress. Reducing debt burdens is necessary to create fiscal space for new investments in priority areas, including green transition. Now, in this context, so far as India is concerned, going by the budget which has now been presented, I think government is adhering to a path of fiscal consolidation, and as per the projections made by the International Monetary Fund also, India's that is general government, the debt of both central and state governments are expected to moderate in the years to come. This is just a point of information to put things in the context. Domestic growth. Domestic economic activity remains strong. The first advance estimates placed the real gross domestic product, that is real GDP growth, at 7.3% for 2023-24, that is for the current year, making this the third successive year of growth of above 7%. Going forward, the momentum of economic activity witnessed during the current year, that is 23-24, is expected to continue in the next financial year also, that is in 24-25. Agricultural activity is holding up well despite lower inflation, lower reservoir levels and delayed sowing. Rabi sowing has surpassed last year's level as well as the normal acreage. The allied sector is also expected to provide major support to agriculture with continued momentum in horticulture and fisheries. Industrial activity is gaining steam on the back of improving performance of manufacturing. The early results of corporates in the manufacturing sector remain upbeat, driven by higher profit margins. The Purchasing Managers Index, that is PMI for manufacturing, is displaying expansion along with strengthening of future activity index. Services sector activity is expected to remain resilient on the back of strong domestic demand and stable global prospects. The PMI services increased significantly in January, that is January this year, suggesting continuing strong expansion. The buoyant demand for residential housing, coupled with increased thrust on government capex, is expected to propel construction activity. On the demand side, improving employment conditions and moderating inflation, together with a rebound in agricultural activity, should push up household consumption. Rural demand continues to gather pace, strengthening farm level activity as reflected in declining Mahatma Gandhi Narega demand, and the extension of Pradhan Mantri Garib Kalyan Anna Yojana should further support rural consumption. Urban consumption remains strong on the back of improved income levels. Investment cycle is also gaining momentum, is gaining steam, aided by sustained thrust on government capital expenditure, increased capacity utilization, rising flow of resources to the commercial sector, and policy support from schemes such as production-linked incentive. Revival in private corporate investment is also underway. Our survey suggests that investment intentions of private corporates remain upbeat, and both services and manufacturing firms are optimistic about overall business conditions. Next, net external demand is also improving with narrowing merchandise trade deficit. Now, taking into account all these factors into consideration, real GDP growth for 2024-25, that is the next financial year is projected at 7%. I repeat, real GDP growth for 2024-25, that is next financial year, is projected at 7%, with Q1 at 7.2%, Q2 at 6.8%, Q3 at 7%, and Q4 at 6.9%. The risks are evenly balanced. Let me now turn to inflation. Headline inflation moderated to an average of 5.5% during April to December 2023 from 6.7% during the whole of 22-23. Food price inflation, however, continued to impart considerable volatility to the inflation trajectory. In contrast, the deflation in CPI fuel deepened and core inflation moderated to a 4-year low of 3.8% in December. The decline in core inflation continued to be broad-based, with inflation remaining steady or softening across its constituent groups and subgroups. The inflation trajectory going forward would be shaped by the outlook on food inflation, about which there is considerable uncertainty. Adverse weather events remain the primary risk, with implications for the Rabi crop. Increasing geopolitical tensions are also leading to supply chain disruptions and price volatility in key commodities, especially crude oil. On the positive side, the progress in Rabi sowing has been satisfactory and augurs well for the season. Prices of key vegetables, especially onions and tomatoes, are registering seasonal price correction. Taking into account these factors, CPI inflation, that is consumer price headline inflation, is projected at 5.4% for the current year, that is 23-24. So that is for the current year 23-24, we are projecting CPI inflation at 5.4%, with the fourth quarter, that is the current quarter, projection of 5%. Now, assuming a normal monsoon for the next year, CPI inflation for the next financial year 24-25 is projected at 4.5%. I repeat, CPI headline inflation for next financial year 24-25 is projected at 4.5%, with Q1 at 5%, Q2 at 4%, Q3 at 4.6%, and Q4 at 4.7%. The risks are evenly balanced. Now, what do these inflation and growth conditions, what do they mean for monetary policy? Let me try and answer. Inflation has seen a significant moderation from the highs of the summer of 22. That is the summer of 2022. Over the last 2 years, monetary policy has prioritized inflation over growth, undertaking calibrated increase in policy repo rate by 250 basis points and withdrawal of stimulus measures. Monetary policy was supported by proactive supply side measures by the government. That said, the job is not yet finished, and we need to be vigilant about new supply shocks that may undo the progress we have made so far. Headline inflation has remained high and has seen considerable volatility, moving in a range of 4.3% to 7.4% during the current financial year. Recurring food price shocks could interrupt the ongoing disinflation process, with risks that it could lead to de-anchoring of inflation expectations and generalization of the price pressures. Adding to these are the renewed flashpoints on the geopolitical front, including supply chain disruptions. Importantly, the CPI inflation target of 4% is yet to be reached. Monetary policy in the midst of these lingering uncertainties has to remain vigilant to ensure that we successfully navigate the last mile of disinflation. Now, the last mile of disinflation is always the most challenging, and that has to be kept in mind. Stable and low inflation at 4% will provide the necessary bedrock for sustainable economic growth. This point is very important, because if we are interested in the long-term growth of our economy, then we need a regime of low and stable inflation. That is why we remain focused on bringing the inflation, to align the inflation to the target on a durable basis. I would now like to focus on the liquidity and financial market conditions, about which there is a lot of interest in the financial markets and also elsewhere. After remaining in surplus during April-August 2023, system level liquidity turned into deficit from September after a gap of 4.5 years. Adjusted for government cash balances, potential liquidity in the banking system is still in surplus, and that may surprise you. But adjusting for government cash balance, potential liquidity in the system is still in surplus. During December-January, the Reserve Bank proactively injected liquidity through both the main and the fine-tuning repo operations to ease liquidity tightness in the system. With government spending picking up and augmenting system level liquidity, I must mention that in the recent, particularly in the second fortnight of January, government expenditure was sustained, but I think there has been a significant pickup from the second fortnight of January, and also we are witnessing the same in February. And so with government spending picking up and augmenting system level liquidity, the Reserve Bank undertook 6 fine-tuning variable rate reverse repo auctions, that is VRRR auctions, during February 2 to February 7, 2024 to absorb surplus liquidity. Financial market segments have adjusted to the evolving liquidity conditions in varying degrees. While the short-term rates have fluctuated, long-term rates have remained relatively stable, reflecting better anchoring of inflation expectations as indicated in the softening of term spread in the government securities market. In the credit market, however, monetary transmission remains incomplete. Let me reiterate, and this is very important, let me reiterate that our policy stance is in terms of interest rate, which is the principal tool of monetary policy.